Right, so Kashya Pujara of Axis is waiting patiently. Kashyap, good afternoon. Thank you very much for joining us on the show today. I was reading your note which you have put out, pretty cautious and laced with a lot of pessimism. I would say India is already in a recession. Now, how should an investing strategy evolve in a recessionary time? What are your thoughts on how things should be approached at?
Good afternoon. I think the key point to kind of note here is that India was already going through a cyclical downturn before COVID actually hit us. And what has actually meant post-COVID hitting us is that we are now going back to a contraction which we haven't seen in the last 40 years. So I think we saw negative GDP growth maybe in 1980s, and we are now at maybe close to negative 2% this year, which is basically 40 years back. And what this kind of means from a market standpoint clearly is that we will see steep earnings cut. And we have already seen consensus estimates for FY21 being cut by 16%. We ourselves as a house, as Axis Capital, has cut our earnings estimate close to 20 to 23%. But we still feel that there are downside risks to these estimates, both at the consensus level and our level. Now, given that scenario, anyone who's looking at the market multiples and seeing at consensus valuations or even our valuations, and maybe a 12-month forward from here looks more like 17 times, and an FY22 looks more in the 14 times multiple. But given that there is still steep earnings risk up ahead, this multiples would look low, would look much higher, and hence it's really difficult to actually build a case of optimism now, given that the narrative is changing by the hour. I think the entire last 1 month, the sharp move that we saw when Nifty tests new lows to us retracing back is nothing but a function of changing narratives, because economy was broadly shut. At the first fall, when we tested the lows in March, it was mainly due to the market narrative that lockdown was imminent. After the lockdown started, the narrative shifted to how businesses would look like after the lockdown opens, or maybe 1 year forward from where the lockdown was. And the current narrative, in our view, is already shifting that to post opening of the lockdown, which is looking more an uneven opening. The narrative would be that the restart of businesses are tricky and the landscape post-COVID could be different. And in the upcoming results season, it won't be surprising if most companies kind of suspend their earnings guidance given the uncertainty ahead. And finally, analysts cut number further. And given that as a backdrop, I think overall, if you look at where this COVID-19 has hit us most, it's actually hit us most at mid MSME businesses or mid to small enterprises and low income households. And this would be one of the key pain points. And households and businesses would essentially look to deleverage, which is clearly negative for consumption. And banks, being the most leveraged business, could have magnified impact of economic downturn, which raises further concerns on asset quality front. So our sense is broadly that leverage consumption has probably peaked in the current cycle, and the onus has to be on the government or policymakers to show leadership and come out with a package which ensures survival of small businesses and low-income households. So that is broadly our thought process. And given the economic uncertainty we are currently in, we wouldn't be surprised if the market hit new lows. Broadly, if you look at the market multiples over time, then the lower end of the band, if on the market multiple, would be something which we called as a reciprocal to bond deal, which is 10-year GSEC reciprocal of that. And if I take 12-month earnings, which are cut by 22% in our case, and we plot that P multiple, which is close to debt multiples, then that lower end of the band works out to 7,500. And the upper end of the band, in our view, is around 10,000. So that's the range we expect the market to be in. We are still close to 20% above the lower end of the band. And history has taught us...
Kashyap, let me interrupt you over here. Kashyap. Yeah. I want to understand from you, what is your FY22 earnings estimate for Nifty? Because as it is, nobody in the next 12, 15 months, or I would say 4-5 quarters, is expecting any earnings growth. So FY22 earnings of Nifty, what level? How are you arriving upon this 7,500 kind of fair value zone? Is it 500 rupees a share or it's 450?
Very candid as to how we've actually plotted the earnings. In the current year, when we've cut our earnings estimate by 22-23%, it broadly implies that in the first quarter, the top line is compressing by 35% for Axis Capital Universe. In the second quarter, we are looking at 15-16% degrowth. Third quarter, we are looking at zero growth, which means you return to normalcy by third quarter. And fourth quarter, we are looking at 15-16% growth on a YOY basis, given that in the fourth quarter last year, which is Q4 of FY20, there was a 14-15 day of lockdown, which was already built in, which hopefully shouldn't be there in next year. And we would have normalized on the COVID front by then, and we will see Q4 of FY21 showing up growth of maybe mid-teens. And in the following year, we are kind of building in that the GDP itself, which is negative 2% this year, kind of resurges back to 10% in the next year, assuming that we would have kind of put the COVID pandemic behind us by then and things will normalize. So you kind of see a resurgence of demand and normalization of consumption in the coming year. And that's how we kind of built out our estimates, that we are looking at a negative 2% GDP growth this year, close to 10% growth next year. Consequently, this year our EPS is cut 22%. And I feel that the growth trajectory could be more severe in terms of a drop than where we are. Also, the margins that we build in, given a lower dip in top line versus a higher dip if it were to occur, then the margin can also compress further. So actually, there is no sanctity of how one can look at FY21 earnings. It could be far more steeper than where we are. And the fact of the matter is no one really knows how it's going to turn out. Neither do corporates nor do analysts. It will only be as we enter the quarterly cycle that we'll really come to know how the situation is getting normalized. Now, as far as FY21 is concerned, we were earlier close to 800 plus on Nifty earnings. And in FY21, we were close to 700 rupees on Nifty earnings. That 700 in FY21 is now close to 530. And the 800 plus on FY21 is now close to 700. So essentially what we were building out in FY21, we are basically building it out in FY22. So you pushed back the number by 1 year. That's where we are. And essentially the market correction that you've seen is mainly a function of a cut and not PE derating. I think both earnings as well as multiples have a potential to get derated further from where we are.
Kashyap, of your portfolio which you're running, the model portfolio, Axis Capital portfolio positioning you've shared with us, banks and NBFCs 28%, defenses 47%. For FY22, what is the operating profit growth which you are factoring in of your portfolio? So let me put it this way, that the earnings growth for us, as far as our Axis Capital is concerned, we are looking at close to 25% plus in FY22, given that we are assuming GDP to rebound by then. However, the current overweight on defensive is more a function of the near-term issue, because please realize that if the lockdown were to extend and the top line cuts were steep, it is not valuation which will be paramount, but it would be liquidity which would be more paramount, because looking at valuation metric alone might not work, because there will be so many businesses which will face liquidity issues. Even for companies which are in strong business segments, how their customers' balance sheet look like, how the suppliers' balance sheet look like 1 year out is anybody's guess. So we are basically taking a cautious stance in the interim. And banks, being the most leveraged play, could be at most risk. And hence we have kind of cut down our weightage in banks from 36% weight on the Nifty, and we were marginally overweight there, to underweight on banks. And there also, if you notice the portfolio, our allocation is in the top tier banks. So we are not actually going out of the top 4-5 names in the banking space. And we would rather play on beta by adding industry recovery plays. So in case if a GDP recovers next year,
then typically businesses like cement, engineering, capital goods, logistics will show a sharp upturn from the lows of the current year. And there we are looking at overweighting some of those spaces, but by keeping in mind that the balance sheet of those businesses that we are looking at should be resilient, which means that debt equity should be moderate, or they should have reasonable cash at hand, so that there is no struggle to cover fixed costs in an environment where banks itself could turn a bit risk averse. So we are going by that we are looking at resilient companies within the segments we want to get overweight on, but we would rather play the industry recovery through core industry recovery plays, real businesses, instead of actually playing it through lenders.
Right. All right. You are saying that next 12 to 15 months could be challenging, but if you stick with quality structured portfolio, then in the next 2 years' time, the delta could reap you good dividends. That's what I understand from the commentary coming in from Kashya Pujara of Axis Capital, talking about how difficult things could be in the medium term. But if elements come into place like the one he's talking about, a stimulus from the government, etc., and the initiatives companies are taking, we could be able to tide over this. Kashyap, thank you very much for joining us and explaining your portfolio strategy and the way you are analyzing the investing environment in these times.